When it comes to trading, the first thing many beginners focus on is indicators. Moving averages, RSI, MACD, Fibonacci retracements, Bollinger Bands, the list goes on and on. It seems intuitive, right? If you can just find the perfect combination of indicators, the market's secrets will be revealed and profits will flow like a river. But here's the truth. No indicator, no matter how sophisticated, can save you from the biggest threat in trading. And that threat isn't the market, it isn't volatility, and it certainly isn't luck. It's your own mind. Emotional control is the silent engine behind consistent trading success. It's the invisible skill that separates the trader who survives from the trader who thrives. In fact, mastering your emotions can often outperform any technical setup, any algorithm, and any perfect system you can imagine. Let's start by understanding why indicators fail when emotions take over. Indicators are tools. They analyze price action, volume, trends, and momentum. They give you signals, but the market doesn't follow signals blindly. People do. And people are irrational. People panic. People overreact. People get greedy. This is where indicators can mislead you if you let your emotions hijack your decision-making. Imagine this. Your MACD crosses the signal line. RSI is showing oversold conditions, and all your indicators are aligning perfectly. Logically, everything screams, buy. But just before you execute, a sudden market dip hits. Maybe a headline flashes bad news, or maybe you just feel nervous. You hesitate. Or worse, you panic and exit a trade that could have been profitable. In this scenario, the indicator did its job. It didn't fail. You did. Not the indicator, you. This is a fundamental truth. Indicators are only as effective as the mind behind them. And if your mind is ruled by fear, greed, or impatience, indicators can become traps rather than tools. So, what does emotional control look like in trading? It starts with self-awareness. Emotional control isn't about suppressing feelings. It's about understanding them and making decisions that align with strategy rather than impulse. Every trader feels fear, every trader feels greed, and every trader faces the tension between acting and waiting. The key is not to eliminate these emotions, but to harness them. Take fear, for example. Fear can save you from reckless trades, but it can also paralyze you into missing opportunities. Emotional control allows you to recognize fear, analyze whether it's rational or irrational, and then proceed according to your trading plan rather than your gut reaction. Similarly, greed can drive overtrading, chasing losses, or adding risk beyond your comfort zone. Emotional mastery helps you recognize when the urge to get more is creeping in and reminds you that discipline trumps impulse. Now consider the power of patience. Many traders underestimate patience because it isn't flashy. There's no indicator that can teach you patience. Yet patience is often the single greatest predictor of trading success. Emotional control allows you to wait for setups that meet your criteria, rather than forcing trades just to feel active. This is why some of the most consistent traders may enter fewer trades than anyone else in the market. They understand that quality beats quantity, and that waiting requires more strength than executing without a plan. Consistency is another advantage. Emotional control gives you consistency because it keeps your decision-making process stable. Indicators give you signals, but emotional reactions can vary day to day, trade to trade. Without control, you might follow your plan perfectly one day and abandon it the next because of frustration, excitement, or a streak of bad luck. Emotional mastery ensures that your trading approach remains consistent, which is essential for long-term profitability. Let's bring in a real-world example. Imagine two traders, both with identical strategies and identical indicators. Trader A has emotional control. Trader B does not. Trader A follows the plan, sticks to risk management rules, and executes trades calmly. Trader B, on the other hand, reacts to every market swing. Sometimes they exit too early, sometimes they overtrade, and sometimes they let fear prevent them from acting at all. Over time, Trader A may actually outperform Trader B, even if Trader B's indicator signals were slightly more accurate, because Trader A's emotional discipline allows them to exploit their edge consistently. Emotional control also helps in dealing with losses. Losses are inevitable in trading. They don't discriminate between beginners and professionals. What separates successful traders is not the absence of loss, but how they respond to it. A trader without emotional control may revenge trade after a loss, trying to win it back, which usually leads to even bigger losses. A trader with emotional control takes a step back, analyzes what went wrong objectively, and returns to the market with a clear head. It's worth mentioning the concept of trading edge. Every successful trader has an edge, a statistical advantage over the market. Indicators may help identify this edge, but without emotional control, that edge is meaningless. You can have the best setup in the world, but if you let fear or greed dictate your actions, your edge disappears. Emotional control preserves your edge, while emotions destroy it. So how do you develop emotional control? It doesn't happen overnight, and it isn't as simple as meditating for 5 minutes or reading a self-help book. Emotional control is a skill, and like any skill, it requires deliberate practice. Here are some key steps. First, define your trading rules clearly. Emotional control is easier when you have a plan. Know your entry criteria, your stop-loss levels, and your risk per trade. The clearer your rules, the less room there is for emotional decision-making. Second, use journaling. Write down every trade, why you took it, how you felt before and after, and what you learned. Journaling exposes emotional patterns that you might not notice in the heat of the moment. Over time, you begin to recognize triggers that lead to impulsive behavior and can take steps to address them. Third, practice mindfulness. Mindfulness doesn't make you emotionless. It makes you aware of your emotions without being ruled by them. When you notice fear, frustration, or overexcitement, mindfulness helps you step back and make a conscious choice rather than a reflexive reaction. Fourth, start small and scale up. Emotional control is tested more by position sizing than by strategy complexity. By starting with small positions, you limit the emotional stakes and give yourself space to practice discipline. As your confidence and control improve, you can gradually scale your trades. Fifth, accept losses as part of the process. Emotional control doesn't mean eliminating losses. It means accepting that losses are inevitable and responding rationally. This acceptance prevents the spiral of revenge trading and protects your account from unnecessary risk. Some traders even employ mechanical strategies to support emotional control. For instance, using automated entries, alerts, or stop orders can remove some of the emotional pressure from decision-making. But notice this carefully. These are tools that support emotional control. They don't replace it. A mechanical strategy without discipline is like giving a car to someone who doesn't know how to drive. It can still crash. Now, let's address a common misconception. Some traders think emotional control is about being cold or robotic. On the contrary, emotional control is about being human, but disciplined. It's about feeling emotions fully, but not letting them dictate your actions. You're not suppressing fear or excitement. You're acknowledging them and acting deliberately. Another misconception is that emotional control is innate, that some people are just born disciplined. The reality is that anyone can develop this skill. Like building muscle, it requires repetition, feedback, and gradual exposure to stress. Every disciplined trader you admire in the market has trained their mind, often over years, to withstand the emotional roller coaster of trading. So why does emotional control outperform any indicator? Because indicators are static, emotions are dynamic. The market is unpredictable, and no indicator can account for sudden news events, irrational crowd behavior, or unexpected volatility. Emotional control allows you to adapt to whatever the market throws at you without abandoning your principles. It's the bridge between analysis and execution, the safety net that ensures your decisions align with your strategy rather than your mood. Let's tie this together with a metaphor. Imagine indicators are your compass. They point the way. Emotional control is your ability to walk steadily across a narrow, treacherous path, even when the wind is howling and the ground shakes. You can have the best compass in the world, but if you can't keep your footing, you'll fall. Emotional control keeps you upright, grounded, and moving forward, no matter how chaotic the environment. Finally, The beauty of emotional control is that it compounds. Every trade where you act with discipline strengthens your mental resilience. Over time, this resilience becomes a self-reinforcing cycle. Better emotional control leads to better decision-making, which leads to better results, which in turn reinforces discipline and confidence. Indicators don't compound this way. They can provide signals day by day, but only emotional mastery allows your skill to grow exponentially over the long term. In conclusion, trading is often portrayed as a numbers game, a puzzle of charts and signals, and yes, indicators can help. But the most powerful factor in trading isn't an indicator, it's your mind. Emotional control determines whether an edge becomes profit or loss. It determines whether a strategy survives or fails, and it ensures that your actions remain consistent, deliberate, and aligned with your goals. If there's one takeaway from this discussion, it's this. Focus on mastering yourself first. Build your emotional resilience, strengthen your discipline, and develop patience. Indicators will always help you find opportunities, but your mind is what allows you to seize them. Emotional control doesn't guarantee profits. It doesn't make trading risk-free, but it gives you something far more valuable, the ability to trade with clarity, confidence, and consistency, which, over the long term, is the real path to success. So the next time you stare at a perfect chart setup, pause and ask yourself, are you ready to act on it calmly, rationally, and without letting fear or greed take over? Because no indicator in the world can protect you from yourself, but emotional control can. And that is why emotional control outperforms any trading indicator.